Hello and welcome to today's webinar with wealthmanagement.com, Seeking Income with Single Ticker ETF Covered Call Strategies. This webinar is presented and sponsored by YieldMax ETFs, the New York Stock Exchange. My name is Mo Sparks, and I'm a Director of Exchange Traded Products at the New York Stock Exchange. And I'll be your moderator today. In a moment, we'll begin our conversation, but first let me explain how you can get the most out of today's event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar or resizing them by clicking on the lower right-hand corner. At the bottom of your screen, you'll find multiple application widgets. Clicking on these icons will allow you to open and close widgets on your screen, but will not remove you from the event. I would note that a copy of today's presentation is available for download on the resource list widget that is located at the bottom of the page. Please note that this webinar has also been accepted for 1 CE credit hour towards the AEP designation program. The live broadcast of this event has also been approved for 1 CFP Board CE credit hour. Investments and Wealth Institute has accepted this program for 1 hour of CE credits towards the CIMA, CPWA, CIMC, and RMA certifications. Instructions for credit submittal are available in the resource list widget as well. During today's presentation, we will welcome questions throughout, and we'll try to answer as many questions that are coming throughout the conversation, but we will follow up post with anything that is notable. Just type your questions into the Q&A window on the left-hand side of your screen and hit the submit button. We also invite you to share your reactions to our presentation today. To do so, simply click on the reactions widget located on the toolbar at the bottom of your screen. Please also note that today's session is being recorded and will be available for on-demand viewing after the event. Simply log on using the same URL that you're using today. Now let me introduce today's speaker, Jay Pestrichelli, co-founder and managing director of Zega Financial and portfolio manager for YieldMax ETFs. Jay specializes in developing successful option strategies to protect investors' equity positions and generate alternative income while driving targeted returns. You can find out more information about Jay by clicking on the speaker bio and by viewing him on LinkedIn. With that, let's get started. Jay, the floor is yours.
Thanks, Mo. Appreciate it. Happy to be here. Thanks, everybody, for joining today. We're going to be discussing YieldMax ETFs. These are options-based ETFs. I am one of the portfolio managers, as you can see here. Mo just gave my bio. Thank you for that. We don't need to spend too much time there. So let's briefly hit high level what the YieldMax ETFs really are. These are generally individual tickers, individual stocks within an ETF wrapper where we are selling calls. And so these are actively managed ETFs that either synthetically replicate the long exposure or actually outright own the long stock, and then covered calls are sold over those positions. And that could be, like I said, on single stocks, on ETFs, and some of the funds that we manage have multiple stocks within them, and we sell covered calls on those. YieldMax ETFs are designed to deliver attractive yields. We'll talk a lot about the distribution rates today when it comes to YieldMax. As the name implies, they are designed to have what I would say, and I know we say attractive yields, you tell me as we get through. Definitely give us some questions in the question section as we go through these, as you start to see some of the numbers here. The YieldMax strategy, essentially, the idea behind it is to convert the volatility of individual stocks or ETFs into cash flow by selling covered calls. We're going to talk a lot about covered calls today, so I won't go into too much detail yet there. And we utilize short-term options that are either near the money or slightly out of the money to take advantage of the natural time decay of option premium. I always like to joke around. The only thing I can guarantee on Wall Street is that tomorrow comes after today, and this strategy is designed to take advantage of the fact that options decay over time. We believe these strategies are appropriate for investors who have a moderately bullish view on the underlying reference securities and who are seeking attractive distribution yields. I'll also add the strategy is also appropriate for investors that are moderate to moderately aggressive and even aggressive in their risk tolerance. There's three families we mentioned a minute ago within the YieldMax product suite, or three categorizations I'd call it. The first and the most number of funds are in what we would call the single U.S. listed stocks. These are companies that typically don't have dividends. There's some that have a little bit, like Apple is in the list. But Tesla, Apple, NVIDIA, Amazon, Google, Coinbase, AMD, MicroStrategy. So we have all of these kind of what I would say non-dividend paying or low dividend paying stocks. ExxonMobil is in there too, which has a decent dividend. But generally speaking, they are non-dividend tickers. Then we have a handful of fund of funds. There's two of these. The fund of YieldMax funds, the kind of universe of YieldMax funds, will hold all of our covered call ETFs within itself. Sorry, a little double there. But essentially, whenever we put out a single ticker ETF or a YieldMax on a single ticker, it will be included in our fund of funds. That is our YieldMax ETF. We also have a Magnificent Seven because we do have an individual ETF for each one of the stocks of the Magnificent Seven. So there is an ETF that covers that as well. We'll hit that in a moment. And then finally is the YieldMax Ultra ETF. This is really a portfolio of covered call strategies on a basket of 15 to 20 individual stocks, so not a basket of ETFs. It's individual stocks that will also run covered call strategies over those. And there is a pretty detailed process that goes into picking those tickers. So these are kind of categories. So we have single tickers. We have a fund of fund, which is two funds of funds, which are funds of our existing ETFs. And then we have the Ultra ETF that is live today. So let's talk a little bit about the single security ETFs. Let's give you some examples of what this really looks like. This is a sample of some of the YieldMax ETFs that we have today. I think there are 19 to 20 live single security covered call ETF products available. They're all listed on the New York Stock Exchange. These are exchange listed options that are issued by the Options Clearing Corp are used to actually sell these calls. And then I will add that Zega Financial, we are the sub-advisor for these funds. We're an SEC registered investment advisor, and we serve as the sub-advisor for all of the YieldMax products. So this is an example of what some of the tickers look like here. The first line here is the Microsoft one. The ticker is MSFO. We tried to keep the tickers generally close to the underlying single stock security that we're using. And so in this case, this is a strategy that is running Microsoft Synthetics, as we mentioned a minute ago. We'll go into more detail, and sells calls on a weekly basis on Microsoft. This fund happens to be live since 2023, listed on the NYSE, has a distribution rate of 42% and an SEC yield of just 4%. Now, I mentioned a minute ago that the portfolios use covered calls and we use synthetics. They also have a basket of treasuries that act as a collateral for that synthetic position. So we will get into more detail in a moment about synthetics. Don't get hung up on that. All you have to realize and remember at this point is that a synthetic stock is essentially going to behave the same way as stock, right? We use options to replicate the long stock exposure. We also have Tesla here, Apple and NVIDIA as some of the underlyings. As I mentioned, these are just four of the 19 that are 19 or 20 that are live today. And you can see that their distribution rates vary.
Yeah, and Jay, maybe on that point, just to jump in, you use that term vary. I do see a wide range from 30%, obviously, to almost 110% in those distribution rates. Why exactly is that?
Yeah, so that's a good question, Mo. So yeah, to have a distribution rate like this, it all depends on the income we could generate by selling those weekly options, right? Selling those weekly calls. And I mentioned earlier that the idea behind YieldMax is kind of converting the volatility of the stock into cash flow by selling the covered calls. And you're right. So based on, you look here at the volatility of Apple, which is going to be lower than Tesla or even NVIDIA, and this is the most recent distribution rate, you can see the NVIDIA rate is, more than 3 times, almost 3.5 times the rate of Apple. And that's because its volatility is significantly higher. I don't think it's any any question that NVIDIA has higher volatility these days than the others on this list. Although Tesla has a fairly high volatility, could be based on its the direction that it is moving as well these days. So I think it's really important here as we look at the volatility of the options to get an understanding of how it's going to drive the distribution rate. And we'll get into that a little more as we go on. But yes, they certainly vary, right? The distributions rates vary. We have JP Morgan, we have a version with JP Morgan, and that is much lower, it has a much lower distribution rate because it is a lower volatility underlying. So kind of a natural connection there between volatility and the distribution rate. I do see a question here that says the volume option for those tickers is 0. I don't think the volume of options on Microsoft or Tesla or Apple is 0. Remember, we're doing the options on the underlying, so on Microsoft or on Tesla itself. This is not options on, well, some of these ETFs do have their own options. We're not selling options on our own ETF. We're selling options on the underlying ticker like Microsoft, Tesla, Apple, or NVIDIA. All right, let's move on to the next slide. So the fund of funds. So I mentioned earlier, we have 2 fund of funds. We have the universe of YieldMax, and then we have the Magnificent 7. Again, still seeks to earn monthly income. These are also listed on the NYSE. So YieldMax Universe Fund of Funds ETF YieldMax invests in the actual YieldMax ETFs, the single stock YieldMax. Currently, there's 18 in the fund of funds. We do have a 19th that has yet to be included in that yet. And then in the Magnificent 7, obviously, we know which 7 those are. Those are in the Mag 7. So actually, we announced dividends. I think the declaration date was today for these 2. We've had a few declaration dates. Today was the declaration date. And these are also coming in at a fairly high rate in the 30+ range. They have an SEC yield that is significantly higher because the dividends are coming from the other components. But you'll notice that because these are a basket of ETFs and a basket of individual ticker ETFs, the distribution rate is going to be, it could be less muted, but it's going to be more like the average of the holdings. And so in this scenario, you get a little bit of the benefit of diversification and also ease of use. As a registered investment advisor, when I talk to folks, and I get asked all the time, which one of the 19 should I buy? Actually, I like to talk about the benefits of YieldMax, which is the universe of them, because A, you don't have to keep up with when new ones come out and add them to your portfolio, and B, you're getting the diversification of multiple tickers, multiple stocks within the portfolio.
So Jay, you kind of referenced there in terms of distribution rate, the difference that exists at a high level, but is there anything that investors or obviously advisors should be thinking about that is different about these distribution rates relative to that was on like the single stock previous page?
Yeah, I mean, the distributions here come from the actual distributions of their components, right? So this is, we invest in a basket of the YieldMax ETFs. It's just an accumulation of the dividends from there. The portfolio generally aims to weight the 18 positions equally. Of course, they'll naturally move and they'll get out of that perfect alignment, but regular rebalancing occurs. I think we aim for monthly rebalancing those, and that's also when we'll add new tickers to the mix. So, for example, with NVIDIA having such a decent run recently, that has grown in allocation size. But when we started the build, it was the same size, and when we rebalance, it'll be back to equal size to the others. But the distributions here are driven straight from the yield of the individual tickers. So, generally, people ask me what to expect on the yield at a YieldMax. The answer is probably close to the average of all the components because they're going to be equal weighted. So that's kind of the driver of what's pushing those yields out, Bob. So thanks for that question.
Yeah, thank you.
All right, so let's talk about Ultra for a moment. So Ultra, fairly new inception date. This is a scenario where we are holding 15 to 30 underlying securities. and then running covered call strategies over the top of that. Again, this is a NYSE listed ETF, ULTY. We do put the stocks through a fairly rigorous screening process. I will admit that we start with volatility first, right? The brand is YieldMax. The primary goal of all of the YieldMax funds is delivering income first. And so when you're thinking about income tickers or tickers you want to use to drive income from a covered call purpose, and anybody here that has sold covered calls before will know this, volatility is obviously important. Second time that I'm saying it. I'll say it probably a few more times before we're done. So we'll look first for stocks that have a fair amount of volatility. Now that doesn't mean those stocks always have to have volatility. We know volatility can change as a stock approaches earnings. So for anybody that's run a covered call strategy before or done or dabbled on their own, you would know that, that week or two leading into earnings is going to have a higher level of volatility than it does, for the other 11 weeks of the quarter. So you'll watch for that. We'll watch for those volatility pops. But we also like, underlyings that have, just generally higher volatility. We'll look also at things like momentum indicators, right? A little technical analysis, whether it's, an RSI screen or a MACD screen or just some broad, bullish type screens. Again, these are covered call strategies, so it's a bullish bias. We want stocks to go up when you're running a covered call strategy. And so, while we're obviously, we'll talk about covered calls in a moment, and they're dynamic as we talk about the option piece. It's really important that, whenever you're picking stocks, you try to pick stocks that are going to go up. Certainly no guarantee anything that we pick is going to go up, especially when you're picking stocks that have a higher volatility than normal, right? So there's plenty of, movement built into the options market. But selling the covered calls over these individual tickers generates quite a bit of premium. Again, we may use synthetics here, and again, that's coming next slide. We'll talk about synthetics, but they're really looking to produce higher levels of income. So with the Ultra, which is in one of our kind of multi-position funds categories, we like to say this one is really all about the yield and about kind of finding those stocks that can deliver, an outsized yield, even comparative to the rest of the YieldMax suite.
So Jay, you touched on kind of process for getting to the portfolio. Maybe for those that are a little less familiar and haven't already been out to YieldMaxETFs.com, what is actually in this portfolio today?
Yeah, so that's a good question. So I think today, and this is all, by the way, like you said, you can find it on YieldMaxETFs.com. You can look at the positions. They fall into multiple different sectors, right? It could be application software, biotech, retail, distributors, payment processing, automotive. Really, there's plenty of technology in there as well, pharmaceuticals, some investment banking and financial stocks, maybe even some healthcare. So, we try to have a broad-based sector approach, right, when we're looking for this to help with the diversification of the portfolio. As you're trying to, here's the interesting that's interesting, right? We want an ETF that has, low volatility, but we know it's made up of a basket of very high volatile tickers. So naturally, it's going to, lean higher than most, 15 to 20 ticker portfolios, right? Just because it's made up of tickers that have a lot of volatility. But we are looking for things that have a decent amount of market cap. They have to have a decent amount of option volume associated with them, right? The price has to be higher than, we're not looking for a lot of $1, $2 stocks here, right? I mean, while there might be a handful under $10, we like to lean towards stocks that have higher prices. So all of those things are important when you're picking stocks in a portfolio that is looking for volatility on purpose. Yeah, it's a little different. I see a few questions here about the Ulti slide. There was a question there. What do we estimate the distribution rate to be for Ulti? So while we had the first announcement for Ulti today, because it wasn't live really for a full month, right? It was only for 2 weeks. Ulti, which I think went live at about $20. announced a distribution today of almost, I think it was just over $1, right? So that's all that's out there in the public domain. So, you could do the math on that, $1 out of 20 for just the first, 2 weeks of the fund trading, right? So it could be a fairly significant dividend. There's a question here about no credit spreads, no iron condors, just covered calls. Those are great option questions. I love talking about option strategies like that. For YieldMax, we are strictly using covered calls. There may be times where we may leg into a call spread, where for whatever purposes that may be, right? Maybe instead of buying back a worthless call, we'll buy a long call and still free up the margin so we could sell a new one, things like that. But generally speaking, no, generally they are short call sellings. Question here, difference between YieldMax and Alti. Alti has 20 individual tickers that are just the stocks, and then we sell calls over them. Whereas YieldMax is holding our other YieldMax ETFs, right? So YieldMax, let me give it as an example here. I think this is the right page. So YieldMax will hold MSFO, TSLY, APLY, MVDY. It'll hold those individual tickers, whereas Alti will actually hold, if one of those made the list, like NVIDIA, if it made the list, it would actually hold NVIDIA stock and sell calls over NVIDIA. Probably in a very similar way to what we were doing in the NVIDIA ETF, but we're not restricted to the existing YieldMax tickers. We could do anything. We could do, I'm thinking MSCI is in the portfolio today, right? Groupon's in there, but we don't have an ETF for those. So this kind of allows us to run a strategy that can bounce between, where the volatility lies in the market and harvest it. We're kind of unconstrained. As long as we're using U.S. securities, we're fine.
James, before you get to that last question, just really quickly, a question off of that is, how often is this portfolio rebalancing, or what does that process look like?
Yeah, so today, again, fairly new portfolio, right? We're on day 13, 14 right now. But we will review the holdings on a weekly basis. The options, however, might be traded even more frequently than that. The short calls, I should say, might be traded even more frequently than that. And why is that? I'll go back to the idea of YieldMax, which is yield first. We always are driving yield. So if I have a covered call that has made most of its money already, we'll cover that call early and sell a new one before its expiration. Right? No use holding a covered call that's trading at a penny or 2 pennies, right? Cover that back, sell a new one if we still believe that underlying belongs in the portfolio. So yeah, but we will change out the positions. So far we've had 3 rotations. Most of the tickers have stayed the same. We've probably moved in and out of maybe 7 or 8. I guess 7 or 8 out of 20. I guess that's not a small percentage that has moved out. But we will reevaluate each week, because if we got into an option or into a particular ticker that had earnings, once earnings are done, volatility usually comes right out of the options, and so we're probably done with that one. So those that are based off kind of an upcoming earnings release probably get rotated out more often. But there's some so far that have stayed in there for the whole time. Coinbase is one that's been in there. MicroStrategy has been in there. SMCI has been in there the whole time. So just a handful of names that are in there. By the way, they're not all big tickers like this, right? I mentioned Groupon a minute ago. Groupon's in there, right? That's been in there from the beginning too. So it's not always just tech, tech high flyers. It's where we could find volatility in the options market.
Do you want to hit on, Jay, this last question that I see over here in relation to where the yield comes from, the treasury yield or the call writing?
Absolutely. Yeah, that's a good one. So let's flip back to this page here. So the answer is most of the yield comes from selling calls. It's the call writing that drives that. That's the volatility that we're converting into premium and then distributing. Here, when you look at the SEC yield, that is what we're earning from the treasuries in the portfolio. It's actually what we're earning from the treasuries minus costs. I think that's the calculation here. So when you take a look at, this is what's driving the 30-day SEC yield is being driven from the bonds, the treasuries in the portfolio. By the way, short duration treasuries, right? We don't want interest rate risk to add into these, right? We really stick with a duration, I believe, of less than a year on average within the portfolio, probably a little even shorter term these days with rates where they are. But all of that distribution is going to come from selling calls. And again, when you look at, say, the volatility of these underlying stocks, it kind of mirrors about what the yield is, right? So the volatility is a big driver of what's hitting the yield because of the premium we're earning through the covered calls. Great. All right, so moving on. I've been talking about this thing about synthetic long positions. What the heck is a synthetic long, right? So maybe first the why, and then we'll talk about what it is. So in order to meet the diversification rules, because some of you have probably thought like, wait a minute, how can you have an ETF that just has, one ticker in it, right? ETFs are supposed to be diversified. Well, the diversification rules require that you don't have more than 25% exposure in a single underlying security. Well, there is an exception. You can have treasuries. You can have concentration treasuries. Synthetics allow us to create that exposure without being in violation of the concentration rules, right? So putting on a long call and a short put, which is what a synthetic is, as you can see at the bottom of this page, long call and a short put equals long stock. Putting those on together is significantly cheaper than owning the stock, right? It may cost, let's say Apple's trading at $175. It may only cost us, $8 for a long call and $8 for the short put. And that $16 is what gets evaluated as the concentration. That is less than 10% of the value of Apple. And so the concentration rule is certainly met in that scenario. So we use it because we want to stay in accordance with the diversification rules. So as I just mentioned a minute ago, the second bullet point, long call and short put create essentially long stock. When I say essentially, what do I mean? I mean, it feels like if the stock moves 2 points, the value of the synthetic will make it feel like you've moved 2 points up or down. These days with interest rates where they are, there's a little bit of cost to carry in the options. Usually in the past that was in the puts. Now it's actually in the calls. Calls are a little expensive when you go out 6 months than puts are. So things like that kind of weave their way in, but that's okay. We have the treasuries that are actually paying for that cost of carry. So it really ultimately within the portfolio feels like long stock, right? That portion of the portfolio always linked the long stock and short put together. That's what we call a synthetic long position. As I mentioned a minute ago, they use significantly less cash, typically less than 25%. So that's really important for us. And then we mentioned that the remaining cash is put in a basket of treasuries. The treasuries act as collateral for that short put, plain and simple, right? So this is essentially a long call with a cash covered put, and that cash covered put is really securitized by, or I'd say collateralized by the treasuries. The treasuries basically are the collateral to have that short put in the ETF. But again, always think of those positions as together. So why, besides the meeting the ETF diversification rules, are there any other benefits of using synthetics? And the answer is absolutely. One of the great things about a synthetic position that is different than, say, just regular stock is that as the underlying appreciates, the synthetic will also appreciate in value, right? The long call will go up, the short put will go down. Those are both positive for your P&L. But let's say those options are going to expire, or let's say you need to roll that synthetic. You can actually realize the gains without taking off any of the position. So let's use an example here. So those of you that have sold covered calls before know that once the stock goes through your strike, you either got to pay to get out of the call. Well, you always have to pay to get out of the call. I mean, you could roll it to try to pay for it, but you got to cover buy and sell another one. But let's say like the stock has significantly gone through your strike, like by 100 points in MicroStrategy's situation. In those scenarios, you could roll up the synthetic to generate the cash, right? So if the stock has gone up 100 points and it cost you 100 to get out of your short call, simply rolling the strikes up on that synthetic will pay for you to get out of your call. You'll generate that $100 by rolling the synthetic, allows you to exit out of the call, and you actually haven't reduced any of your exposure. If you did that with stock, you'd have to take off a portion of your stock to pay for the covered call you'd have to get out of. So anybody that's been in this situation and you have to come up with the cash to get out of a short call that's really in the money, you usually have to sell a few shares of the stock to pay for it, and that reduces your notional exposure to the stock, right? Because you didn't participate as much on the way up. Well, with synthetics, it's a nice tactic that rolling those synthetics allow you to earn the cash. You can roll the exact same number of contracts, and that will help you get out of the covered call. So it's a nice tool to use within an ETF. And the other thing about that I'll mention here is instead of we talk about covered calls or we talk about early assignments, one of the things that's really important for us is we don't ever want to hold the stock in the portfolio. And while we're actively managing the short call, I mentioned a minute ago that we may cover buy a call that has no time value left. Again, no use holding a short call that's only worth a penny. When you're looking at the synthetic, your intention, these usually don't get traded that often, right? The idea is they are just kind of the collateral for selling the short call. Well, you don't want to get assigned on that short put. Remember, when you're short an option, the long holder of that option on the other side has all of the control, right? You have the obligation, they have the control. And so you don't want to get assigned. And so we'll actually protect ourselves by using what's known as European style options. We do these with flexes, and a European style option can only be assigned on its expiration date. So there's American style and European style. American style, most single stock, most equity stocks have American style ETFs. Sorry, American style options. Wow, I'm getting tongue tied there. So what happens is when you have an American style option, it means, and you're short, it means the holder of the long call can assign you at any time. You can get assigned at any time. When it's a European style, you're restricted to only on the day of expiration. Actually, it's only at expiration. It's not even during the day, it's at expiration. And that would only be in scenarios where the option was in the money. It wouldn't make sense. You wouldn't get assigned when that option is out of the money. So that's what we use to kind of protect the portfolio from getting assigned early, getting assigned long stock, right? So if you get assigned on a short put, right, it gets put to you, right? So you're buying the stock in that scenario. So a lot of things going on here with synthetics. They have a lot of use cases for us, but we also want to make sure that the options don't have an adverse effect on the portfolio and cause us to violate the diversification rules. So, mouthful on synthetics, Mo. I know, a lot going on there.
There's a lot here. Useful information.
All right, so let's talk about the idea of covered calls. It's probably the first option strategy that most of us learn. People would say it's option 101. I don't know if that's really true. There's plenty of activity that has to happen with covered call selling. But for us, with the YieldMax funds, we, again, I mentioned earlier, like to take advantage of time decay, right? The whole tomorrow comes after today thing. And so the primary driver of returns, as I mentioned before, is the premium that's received from selling these out-of-the-money calls. I'm going to get to out-of-the-money in a moment. Typically, we're between 0 to 15%. This is 5, but it could be 0 to 15% out of the money when it comes to those options. I'll explain a little bit why that matters. This, again, the structure can be viewed as kind of a replication of a covered call because we've got that synthetic, which makes it feel like you're long stock. And because of that, we can then sell weekly calls against that. And the idea here is to kind of capture a portion of the upside appreciation of the stock, but most importantly, again, income. If there's three things that are important to YieldMax, it's income, 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 and then upside after that. But upside is still an important concept when it comes to covered call selling. We'll talk about that in a moment. We like to use weekly options when we can. All of the single security, single ticker ETFs, like the Microsoft and the NVIDIA and the Tesla ones I mentioned before, those sell weekly calls. And the reason why we like to sell weekly calls is that selling short-term options multiple times can generate a higher yield than selling a longer dated option one time. That's what these little curves on the right are supposed to illustrate. That, while you have time decay of option always accelerates towards as you get closer to expiration. Of course, deep out of the money options will have time decay at a much earlier date in their life cycle. However, we are selling options that are closer to the money. Even, I would say 10% with a week to go still may be considered for some volatile stocks as having a lot of time decay, having a lot of options juice in them. It's still important. So we like to sell that multiple times because it'll end up delivering a higher distribution rate, delivering higher option premium income.
So,
and then the other thing that I think is important to mention, and we'll hit on it in 2 slides, that selling calls limits the upside participation. By actively managing the portfolio, we'll regularly kind of unlock upside capture. So let's go back to that scenario where you're a call seller and the options are in the money. And sometimes they're like, well, it's going to cost me to get out of this position, right? I don't want to pay that. I'm trying to generate income by selling calls. If I sold a call for $2 and it cost me $10 to get out of it, I think I should wait. Maybe the stock will pull back. For us, it's more about earning time decay, right? Earning that option premium. And so time decay can go to 0 in an in-the-money option as well, right? Just as much as it can with an out-of-the-money option. So you can have an option that's $10 in the money. It may have no time value left. It may be exactly 10 points in the money, right? It may be a 210 call sold and the stock is trading at 220, right? That call is 10 points in the money. If that option is trading at $10, we'll close that early, right? We'll roll it up. We may roll the synthetic, whatever we're going to do to manage that position. We won't just sit back and wait, right? We're going to regularly lock in and take multiple bites at the apple of earning time decay. There are, so maybe I'll pause for a second there, Mo. Any comments that you might have on call selling?
Yeah, I think my question, you addressed it, I think, pretty well there, was in relation to what do you do when obviously the weeklies are in the money? How do you handle that? How does that influence the portfolio? And how often are you monitoring this maybe for those that are less familiar?
Yeah, so look, we've picked volatile stocks and we've decided to sell calls on them, right? So that means on a fairly regular basis, there is a chance that those calls go in the money, right? So, there's a couple tactics that we can use, and I've hit on it a minute ago, but I think it's really important here because this is not, what I'm about to say is not options 101. What I'm going to say here is maybe it's more like a, 200 level class where we would say, look, there's ways to roll out of options calls that are in the money. There's a few ways, right? So we always know you're going to pay to cover back an option that is in the money. Well, if the first thing we always try to do is to try to find an option that we could sell and get more premium, but we still want to earn our income target. So let's say we're trading on Tesla. It's got a 50 volatility, and I'm trying to deliver 50% yield on 50% distribution on an annualized basis. Well, in that scenario, by the way, that's about 1% a week, right? I'm doing some round math here, right? 50%, 52 weeks. So let's just say I'm trying to sell for 1% a week of option premium. If I have to cover by, let's say, a $2 call, I want to sell the next one for $4, and I can still have a net income of $2, right? Cover buy one for $2, sell one for $4. You're still making your $2 of income, and $2, well, it's just a little higher than 1% on Tesla. But you get the idea here, where you could just roll the call and you go out in time. Usually, if you want to do that, you're going out, 1 week or 2 weeks. The nice thing about the higher implied volatility tickers is as you go out in time, the price of those calls will increase, right? Time decays it goes both ways, right? As you add time, you add theta, which is the rate of change of time decay in the option compared to as time ticks off. So you'll add premium in that scenario. So that's just a simple roll, right? Roll it up and out, we may say, right? If I took it from the 175 to the 85 strike, I've unlocked some upside, and I brought in my, target of $2 in that scenario. Another tactic that we may use, I mentioned a minute ago, like for really deep in the money calls, like something's really moved on us. Like Coinbase has been a very volatile stock lately, and it's moved up. I think it's run to 200 down to 100 back. I think we're trading in the 250, 260 range today, right? That has been a very volatile ticker. In those scenarios, you can't always roll for a credit, right? You might have gone, the call might have got too far away from you before that time decay has shrunk enough. So in those scenarios, we'll take advantage of that synthetic stock, right? We'll roll the synthetic stock, unlock all the gains that the underlying ticker has appreciated during that time period, cover by our call, sell a new one at a higher level. So, in those scenarios, you're able to harvest a gain in the synthetic roll, right? So you get the upside of the stock. The call might have cost you to get out of it, but we know you still have earned your time decay, right? So in those scenarios, I think that's probably another tactic that a lot of folks don't always get to use. Now, if you're running a strategy on options, I mentioned earlier, if you're just running it based off of long stock that you have and that call goes in the money, well, in those scenarios, you can just sell some shares. I mentioned it a little bit ago. You don't have to have all the shares called away, right? I talk to clients from time to time and they say, wait, are all my shares going to go away just because my Apple stock is, $1 in the money versus the option? And the answer is no, right? It only costs you $1 to get out of the call. Sometimes it's worth it. Just pay the $1, sell a few shares to pay for it, right? With Apple trading at 175, I sold one share. That just paid for 175 calls I had to get out of, right? That math is very easy. You don't always have to deliver your stock. There's actually a lot of ways to avoid that because a lot of folks have kind of low cost basis that we do this for. So that would be kind of another way of managing an in the money call that has gone up, right? So you've got rolling for a credit, you've got rolling up the synthetic and establishing a new call, or you've got covering the call and paying for that with a little bit of the long stock. So those are three ways that you could kind of deal with an in the money call.
Useful. I think, Jay, I see here there's a good question that came through that talks a little bit about how you actually put these into play in a portfolio. And so the question from Chris is, are these funds meant to be buy and hold strategies for the yield over time? And then the secondary question is, how do you expect these to work as the market goes down?
Got it. Sure. So the first thing is, we do see these as meant to be buy and hold strategies. They're not leveraged in any way, right? We only have 100% notional, right? So these are not leveraged products that we consider more of a trading product. They don't have kind of what I would call a contango risk of a futures-based product, right? So it's okay to hold these over time. They don't have like the natural erosion that some other, derivative-based ETFs may have. And the reason why we say that, though, there's a tactic here to help because the distributions are so large, right? I mean, I think I'm going to go back to the slide here. I guess large is a quantitative number, but I don't know many things that have 100% yield, right? Let's just admit that one's kind of large. That will decrease the NAV, right? Like when you pay a dividend, you have the stock or the ETF goes down by the amount of the dividend that gets paid on X date, right? So, if we were paying, let's say NVIDIA, our ETF was trading at $20 and we paid 100% distribution rate that month, right? You do that math, it's like an 8% decline for that month in the underlying, in the ETF. So in those, but you got the cash, right? You got that cash. And so if you're going to hold this for a while, you have to reinvest those dividends. We like to tell people that are going to hold these for a while to implement a DRIP, right? A dividend reinvestment program where you are putting that back in. And so think about how you allocate as an advisor, right? Or as someone that's managing money. You build a position because you want a certain amount of dollars allocated to that position. Well, if you're having distributions that are, look, NVIDIA has not always been 100% distribution rate, but it has done this before. So if you have that, though, on some of the other tickers, you're going to essentially, convert your ETF to cash if you're not reinvesting. And so by simply reinvesting and buying more shares after the distribution, dividend reinvestment is a very popular, long-standing strategy, right? I think we could write. There's books written about this. This is not just us saying buy more of our ETF. It's about managing the position size. So by buying more shares after the distribution, you could then increase your holdings after it dropped, so your holding size after it dropped after the distribution. And so you can hold these, we believe, in a portfolio because you're increasing your share count and keeping your allocation percentage the same. So if you're willing to do that, then we do think these are meant to be held. We do know some investors like to buy it right before the dividend. Don't know why folks do that, right? It's just going to go down in price the next day. Then when you get the cash, you could buy more. And it's one of those things that it just feels like some folks want to kind of capture that. But for us, when we look at it, we think it's probably better to hold it over the long period of time, take those distributions, and reinvest in the dividend. The second part of the question, Chris, was how do these do in a down market? So let's start with there's two main components to the answer here. The first is covered calls are generally bullish neutral strategies. So if you're in a bullish position and the market goes down, you should expect the stock or your ETF to go down in value, just naturally going to happen. And we'll talk about kind of the risks of the strategy. That is the number one risk to the strategy, is that the underlying you hold goes down. If you're bearish Tesla, you should not buy Tesla just for the call premium, because the underlying asset will drop. So in a down market, these will go down. And look, some of the names I've mentioned, like on this list, have a fair amount of risk in them, right? Nobody is saying these are conservative. Don't let the yield name fool you into thinking these are generally conservative. I actually would categorize these as risky as stock. Whatever you would call stock, if you would call that a 4 out of 5 or a 4.5 out of 5 risk, then that's what you should think about with the YieldMax ETFs. We'll get to risk in a moment. So the first thing is they will go down when the market's going to go down because they will follow the path of the underlying ticker. The second piece, though, which is a benefit, is that usually volatility is higher when the market is going down. In those scenarios, we should have higher distribution rates because we are earning more from selling the options, which have a higher premium due to the higher volatility. So I'm not saying that will offset the decline in the stock. It might. I don't know. Generally, I don't think it would, because the most significant risk here is the direction of the underlying stock. And if that goes down, your ETF will go down. No doubt about it. Like any covered call strategy, right? Covered calls have been around a long time, right? This is not something that we invented. So maybe we'll talk about that in a minute. But I think I kind of hit on your answer there, Chris, where they'll go down when the market goes down, but the yield will most likely go up because volatility has also gone up. So let's talk about those distributions for a moment. So the YieldMax ETFs are designed to pay monthly distributions. So we pay out monthly. The premiums from selling call options will drive the rate of the monthly distributions. So, we've been asked this question a lot, like, how do you come up with what the yield should be? How do you come up with the options you're going to choose to sell? And the answer is we let the options market tell us. We'll look at the implied volatility, or what the options are pricing into the movement of the stock. We'll let that be our guideline. So again, I mentioned a minute ago, if something has a 50% implied volatility, their options have a 50% volatility, we're going to try to sell calls at an annualized rate that would earn us 50%. In that case, about 1% a week. That's kind of where Tesla has fallen over the last, over history since we've launched it. But if you look at, say, an NVIDIA that has right now about a 75 implied volatility, guess what? We will sell options that will target a distribution rate of 75% on an annualized basis. We let the options market tell us. And believe it or not, more often than you would think, it actually prevents us from getting too close to the market or from guessing about how much upside we want to capture within the structure. So we let that make the decision for us. We also like it because anybody could kind of follow along and say like, hey, what should I expect in the yield out of Apple, right, or Appley, right? Well, look at the implied volatility of Apple. That is the main driver of the monthly distributions. As I just mentioned a second ago, sales proceeds from selling the calls will be correlated to the IV of the underlying. Sorry, implied volatility. I say IV. It's a little options jargon. My apologies. And the higher the implied volatility, the higher the option premium we will generate. The next point here is a little complicated one. I'm going to read it and then I'm going to describe it. So it says, a YieldMax ETF's notional exposure may avoid decreases caused by monthly distributions because the synthetic long can be rolled up to help generate cash profits. That's what I was talking about earlier, that you can roll up the synthetic to help pay for the call that we have to cover. There's a lot of times some cover call strategies will kind of cap themselves out. We absolutely have that risk, and we'll talk more in a moment about what's going on with cover calls. But I think it's important to understand that there are times that we will have profits from rolling the synthetic that any ETF is required to distribute 90% of their gains. And so we will naturally have gains from just rolling of that synthetic at times when we're capturing upside. And so that will increase the yield. So I mentioned a minute ago, NVIDIA has a 75% implied volatility. Well, that last distribution was 100%. Well, where'd the extra 25% come from, 30% come from? It came from the rolls of the synthetic up as the stock was appreciating and us realizing some of the gains of the underlying. And so we will distribute a portion of that as well. Of course, the treasuries provide some yield as well. I'm keeping track of the time, Mo. Don't worry. I'm doing all right.
You're doing a great job. You're doing a great job.
So let's talk about the risks. I think I mentioned a second ago, as with any covered call, we have market risk, right? You absolutely have stock market risk. This is not just unique to us with the YieldMax products. It has to do with really just any covered call strategy. If you look at this P&L chart over on the right, and the blue, we call it the options hockey stick. The hockey stick kind of shows that as the market drops, so will your P&L on the y-axis, right? But just like stock would, right? So it's really important to understand that when you're buying a YieldMax ETF, you are taking on the risk of the underlying ticker, no doubt about it. If you want Tesla risk, if you're comfortable with Tesla risk, you should be comfortable with owning Tesla. If you don't like the risk of NVIDIA, you should not buy NVIDIA, right? It's just plain and simple there. Is strategies not considered hedged? I don't consider it a hedge. I know the yields and the distributions are high. I still wouldn't call it a hedged position. I wouldn't call it a buffered position. There are other strategies for that. This is more about distributions and yield. The last piece I'll come up here, I'll bring up is that you can see there's that flat part of the covered call P&L. The upside appreciation is capped. Happens all the time to us, right? While we still will roll our synthetics to capture some of that upside movement, we do have a cap, right? And so one of the risks that a lot of folks talk about with covered calls is, oh, I don't want it to go up too fast. And that's kind of true, right? I'm happy when a stock goes up and caps me out. It means I've made the most that I could make. This means not only did I make my income target by selling the call premium, I actually also captured some of the upside movement of the stock. In this particular example, you could see that we've sold the calls that are 10% out of the money. That's right where the hitch is. I'm trying to look for my little tool with the drawing tool, and now I've missed it somewhere, but I'll find it later. There's that little turn in the P&L for the covered call. So in this particular position, if this was your P&L exposure, you've got upside capture in the stock of 10%, plus the extra above and beyond the stock at that point of the income you made by selling the call. So this is why you're willing to cap the upside, is because you're generating the premium from selling the calls. All right, one last slide that I want to go through, which is, again, volatility drives distribution rates. If I haven't said this once, I'm sorry. I think I said it like 8 times, Mo, right? It's so
Might be at 10.
Again, you could see that there are times where the volatility of this, in this case here, this is our most recent distributions, where Microsoft, while it had a 22 implied volatility, we still were able to deliver a distribution rate of 41%. Why is that? Talked about it earlier. It's because Microsoft has been running up and we've had to realize some of the gains of rolling our synthetic. So half of the distribution rate in this scenario came from rolling our synthetic, right? That's great. We like when that happens. Like, we like distributing cash to our ETF holders. Tesla is closer in line, Apple slightly above, NVIDIA, there's the exact example I gave before. The IV is 72, yet we had a distribution rate of 108. A lot of that came from the appreciation of NVIDIA. So if I had picked a stock that was really going down quite a bit on this list, you would see the implied volatility would track closer to the distribution rate. In these cases, in the most recent period, they all had fairly positive movements of the underlying stock, and we were able to capture some of that, and that went into the distribution as well. Again, it's something to keep in mind, and it's why we like to say, you want to reinvest the dividends, because you can have these large distribution rates, and you don't want to reduce your exposure to the underlying ETF.
So maybe, Jay, as we're starting to wrap here on time, and I think we see 1 or 2 questions, but I do want to kind of give you the opportunity. You walked us through kind of the story, obviously, of the firm and the various options you kind of have. As you said a moment ago, covered calls have been around for a while in these strategies. When it comes to YieldMax, what do you see as the difference in your strategies versus others that are even in ETF wrappers today?
Yeah, thanks. So you're right. We're not the first cover call ETFs, right? There's some very popular ones out there. So the difference for us is twofold. One, the frequency of selling calls, right? Following that mantra that selling calls more often generates more premium, right? Selling 4 times a month should generate more time decay than selling a 4-week option once, right? That's the first thing. The second thing is we like to sell out of the money calls because we want to capture some of that upside, more of the upside. A lot of the large covered call strategies that have been around for a while sell at the money calls. Now, that is where there is the most premium. We know that. But because we're trading more volatile stocks and not trading, always an index, in that scenario, we want to give ourselves some upside capture, right? We want the fund to be able to get the appreciation as well as that time decay. And the slide that we're looking at here, where you can see the amount of upside capture we were able to add to the distribution, it far exceeds the smaller addition that we could get by selling it at the money call. So 2 differences: more frequent call selling and selling out of the money to capture more upside.
Useful. Well, I think we're right at about time. I see one of the questions in relation to your background, how you learned about options. Maybe just a quick plug on, for those that are approaching options for the first time, any resources you direct people to beyond YieldMaxETFs.com.
There's this amazing, wonderful book called Buy and Hedge: The 5 Iron Rules for Investing Over the Long Term. I'm saying that facetiously. It's my book that I wrote in 2010. But no, it's an options, it's a do-it-yourself book. Look, there's a lot of different option books that are out there. I would tell you, definitely do your research on this. But, in our space, we all say we pay tuition, and those tuition costs come from having the trades that go the bad way. You should learn from all of those bad trades. But in all honesty, nobody ever wants to invest other people's money and learn options. But, I think there's some good option books out there. And I think doing some on your own will be, extremely invaluable. I always encourage option trading.
I'll give you, Jay, one last opportunity. Anything else that you'd like to share with the group that joined us today to learn more about YieldMax ETFs, or how they can find you best?
Yeah, so as you mentioned before, my firm is Zega Financial. Thank you for that, Mo. Anybody can find me. My bio is there. I think I would say when it comes to YieldMax ETFs, remember this, right? The yield doesn't mean return, right? When you see 100% yield, it doesn't mean you're going to make 100% total return on your position. Remember, total return is the amalgamation of the dividends and the price change. Use total return when evaluating whether you like to use these YieldMax products. Don't just look at a chart, because the world isn't used to looking at ETFs that have a 3, 4, 5, 8% monthly distribution. It just doesn't look great on a stock chart, yet the returns are what's important. So use total return when evaluating whether these are appropriate for you. And second, remember that the risk you take in these ETFs has everything to do with the risk of the underlying. So make sure that you remember, just because there's a yield here doesn't mean it's conservative. Understand the dynamics of a covered call strategy has almost all the downside risk of the stock, and it caps some of the upside. Of course, we get yield, we get that distribution to pay for it, but it's really important to understand those dynamics. All ETFs are not created the same. These are absolutely distinct. And I would say that, understanding that dynamic is really important. But we think that they are good vehicles for clients looking for alternative investment income. And that's what they're all about. Option premium is an alternative income stream. And I'll end at that.
Sound advice and great closing comments. Jay, obviously, thank you so much for the time this afternoon, and for all those that tuned in. As we said, feel free to pass this to your colleagues as the recording, will be available post. There will be a short pop-up that will occur after we close. There's a survey. We'd appreciate responses. Feedback is important to not only New York Stock Exchange, Wealth Management, and YieldMax, and ensures that we obviously have the best programming moving forward. So on behalf of wealthmanagement.com and the New York Stock Exchange, thank you very much again for attending. Have a great rest of your day.